you know, this next year in particular, we have declining PMI, we have very low consumer sentiment. Europe's facing acute energy issue. China's had these extreme lockdowns. Russia's impacted by all of the sanctions, and so there are spots of growth around, right? But it's a very challenging environment overall. In the past several years, you've had now two blowups in the energy U.S. energy pipeline space. The first one was back in the whole 2015, 2016 period, and then you had a kind of another one during COVID that kind of took out some of the stragglers. And so now that the dust kind of cleared, I actually really like that space. I think it's more appropriately levered, given it's still an asset heavy business, kind of utility like. So they of course they have some leverage, but it's now back down to very reasonable levels. And I think that they're kind of well positioned here. Their valuations are totally reset. And there's a couple ways to play it. One is you can focus on the really high quality names. So, for example, I like Energy Products Partners. EPD is the ticker, and they're one of the ones that never blew up, right? So they never had to cut their distribution. They never got over levered. Whenever these slowdowns would happen, they just would kind of stagnate for a couple years and then resume growing. So they'd run into headwinds, but they wouldn't blow up. Basically very well managed, very diversified. So it's not just oil, right? It's oil, it's natural gas liquids, it's petrochemicals, right? So a lot of different types of energy and refined products transporting and storing and exporting. With, say, Europe's energy system crippled at the moment,
Yeah.
and basically still a long-term prospect for emerging market energy demand growth. I think that basically the U.S. is well positioned in terms of energy production, and then particularly energy transport. And so I like that space quite a bit. And you can also play it with the ETF for the space, which is AMLP. So one of the downsides of pipelines is that a lot of them still are structured as partnerships, and so they issue a K1 form. Basically, at tax season, it gets a little bit complicated, and that actually keeps a lot of fast money out of it. And keeps kind of the valuations a little bit lower, a little bit more frictions, which is really good if you're a multi-year investor. You get higher distributions, you get better compounding. But if you want to get in for 9 months and then out, then something like the ETF could be a better way to play it. The lack of quantitative easing and the potential beginning of quantitative tightening, that makes it a little bit more tricky for asset prices to keep growing. That doesn't mean it's impossible. I mean, there are periods where asset prices can go up quite a bit. But I think that given the other factors, declining PMI environment and tightening policy, there's kind of if you run kind of a back test on that scenario, it's pretty poor for asset prices. And so a lot of that's already been kind of priced in, right? So the market's already front run the Fed, for the most part, and other central banks. I'm not sure they're going to be able to get as tight as they are saying that they're going to get. I think they're going to try to tighten until something kind of
Yeah.
forces them otherwise, right? So until credit markets get a liquid, treasury market gets a liquid, or a recession indicators start to kind of pound them, I think they're going to try to tighten. And so I think that that's kind of a choppy environment, a challenging environment for a lot of asset prices. But I think a lot of that's, it's going to come down to whether or not they end up tightening more than the market expects or less than the market expects, because the market already has anticipated a certain amount of tightening. Basically, what's hard is that they're tightening later than they normally would have, right? So kind of like how in late 2018 they had already been tightening for a while, but then growth started to slow down, and then, so that's when they ran into a problem when they were going about autopilot tightening at a time when you had just economic growth rolling over, and so eventually had illiquid credit markets, and they had to turn kind of turn around, do the famous Powell pivot, and so I think that they're kind of in a similar situation. It's obviously a little different, but I think that they're in a similar type of environment where they're trying to tighten into a slowdown, and I think it's going to get messy at some point. I just don't know exactly where that mess is going to show up. I mean, I think there's kind of self feedback loop where if they tighten too much, they strengthen the dollar, they increase hedging costs, foreign sector doesn't buy as many treasuries. Banks are already stuffed full of treasuries, right? They've been huge buyers of treasuries, and if they then start to do quantitative tightening, they start to let maturities roll off. That kind of squeezes the treasury market. This next year in particular, we have declining PMI, we have very low consumer sentiment. Europe's facing acute energy issue. China's had these extreme lockdowns. Russia's impacted by all of the sanctions, and so there are spots of growth around, right? But it's a very challenging environment overall. And while commodities and energy and things like that are scarce, it's hard to get a lot of abundant growth, right? It's kind of a pressure that kind of makes it hard to grow from. And so I think that this will be a decent decade for nominal growth, but I think a big chunk of that will be inflationary, and that real growth will be tricky to come by. Now, it's possible that by the end of the decade, if some of these release valves kind of get pushed or not, you could have kind of a mini boom. But I think that until some of those structural changes happen, I don't see this as being a very good environment for real growth. I think so. I think because they're already kind of gridlocked, there's not really a lot happening now, and then probably not going to happen after midterms, right? Because they'll still be gridlocked, arguably more gridlocked, at least unless polls are way off. And so um, I think some of the actions are to try to go, kind of at least tame inflation prior to the midterms, right? So, for example, drawing down the strategic petroleum reserve. I think that's somewhat of a midterm play. So I think that around the margins, it's a factor. But I think that overall, the fact that they're already basically in gridlock, that's kind of already the case. So I think that it's hard for the executive branch to unilaterally do a lot to spur growth in the next several months. And so I think that the kind of declining PMIs, the supply chain issues are going to kind of take precedent, and therefore I view it as a more defensive type of environment. Many energy producers are not investing heavily in capex, and you have kind of bottlenecks in terms of allowing new pipelines to be built, and so you could get stagnation in the space, and therefore you might not perform terribly, but you might, for example, underperform the S&P 500, which would be a shame. As I previously described, in kind of my other, writings and podcasts and things like that, in the 40s and the 70s, you had disinflationary periods within overall inflationary decades. And so I wouldn't be surprised if the 2020s be the same way, where I think this is going to be a fairly inflationary decade, but that there's going to be counter trends. There's going to be periods where central banks fight back. There's going to be periods where fiscal authorities are not giving out money. And so that takes some of the edge off of the demand side and kind of transitions it from, say, a reflationary environment to a stagflationary type of environment where you still have constraints on the supply side. Some of them are even getting worse, but the demand side softer. And so I think that can manifest more so in shortages than just prices keep going up, because people just don't have the money to buy some discretionary goods. If they have to kind of prioritize the essentials, and so that's kind of relating to defensive positioning, because if you have high inflation but you also have growth, you can go into more risk assets. Whereas if you still have supply issues, but that demand side is going down, then you want to be careful about some of the more kind of retail, consumer type of discretionary products and services.